Hello, everyone. Welcome to the London Property Podcast. I am Marius Nazare, and I'm here with my co-host, Chris Mulry. This is vlog 18, and we've got two very interesting news articles. I would also like to take the opportunity before we dive into news of the week to thank everyone who has been watching the previous episodes, who have been contributing, who have been commenting, and have been taking part in the conversations that are currently happening on YouTube. We definitely encourage you to, if you do enjoy the content and you want to stay up to date to the latest kind of news in property, specifically for London, then we encourage you to subscribe to our YouTube channel. We're also available in podcast format on Spotify and Apple Podcast. So now we can get straight into it. I'm going to be talking about the Coutts London Prime Property Index for Q1 2020. Now, for those people who don't know who Coutts are, they're essentially a private bank and wealth manager. They are very reputable and well established. They are part of RBS's wealth management division, so a very reputable source. And essentially to talk about how the prime property market and prime central London property market was seeing a very strong rebound after the election, so Q1 of 2020, and essentially how coronavirus has essentially put a stop to this rebound. What's important, and I think it's very interesting, their analysis and their research essentially talks about how we had this rebound, we had this demand that was released straight after the election. And they talk about how many of the elements which facilitated this rebound in Q1 2020 effectively they haven't gone away because of Corona. And they talk about obviously the renewed political stability and certainty after the general election we had. They talk about the limited supply that you have in the prime markets, which ultimately will create a lot of competition amongst buyers. They talk about the weaker sterling, which obviously currency is a massive factor, especially in a market where you have a lot of international buyers, and also combined with the new overseas stamp duty surcharge that people who want to buy property in the UK will be paying as of April 2021, which is a 2%. So that combined, obviously, again, it will attract a lot of international buyers into the market. And thirdly, they talk about obviously the historically low interest rates. And ultimately what they're saying in their index, they talk about how these elements haven't gone away, and what they suspect to happen after the lockdown is lifted, that a lot of these things for the prime central London market will create a very positive ground for things to recover very quickly. And if the exit strategy for the lockdown is actually managed effectively, we could be in a position where the prime central London market resumes from very much where it was before the lockdown. So that's quite interesting, Chris, because we had obviously some people saying, there'll be massive discounts and unemployment is going to massively impact negatively the property market. But yeah, it's important, and we said it even in the last 3 or 4 weeks, it's so important to distinguish between the different markets, and you've got different markets within London, and obviously across the country, certain markets will take a massive hit because they might be more impacted by unemployment. So I think this index and their analysis of the situation is really spot on, because a lot of these things haven't changed, and the prime central London rebound, as they call it, has just been put on hold. So quite an interesting and positive bit of research that a very reputable organization have come out and put forward. So what are your thoughts of these elements? Do you think they will be unchanged after the lockdown? Is there anything that perhaps they might have missed? Obviously, we're on the ground day to day. We're dealing with both buyers and sellers. Do you think it's an accurate, it's a valid analysis that they have made on the situation for prime central London luxury property?
I think so, and I think it also concurs with a lot of the other serious research that's coming out at the moment. You do have individuals on the one hand, particularly buyers, who seem to think the market is going to crash, and then you have some big institutions such as banks like Coutts, such as Savills, such as CBRE, such as Knight Frank, and other large institutions are not forecasting anywhere near the kind of levels that people think the market is going to come down by. And I was on the phone to somebody in financial services the other day, an equities trader, and his argument was, the property market is like any financial market, and it's going to react accordingly the same, to kind of what happened with the stock market. But the thing is, what some people don't understand is the property market isn't that fluid in terms of, okay, if you're selling commodities or equities, the price can collapse within a day. But the property market, from putting a property on the market, making the decision to list it, get it photographed, put on the market, find a buyer, it can take you 2, 3 months, 4 months, 6 months. By that time you even find somebody for the property, this situation might look completely different to what it is. So we've got to take it over a much longer term perspective than being some day trader selling equities and the equities collapsing by 50% in a day. So I think that's what some of these large institutions kind of understand. And I think it's really interesting research. And also we've got to realize that the property market isn't just about what a buyer wants to pay for it. If you're a seller and you own a property, more likely than not, it's going to be one of the most expensive, assets that you have. And therefore, you're going to be very careful when you come to sell it. If you don't think you're going to get a great price for it, and you're not forced to sell, like we spoke about in the last episode, where interest rates are at, they're pretty much nearly at zero. Not that many people are forced. Some people, maybe, but you're not going to sell unless you're really forced into it. And at this point in time, we're not seeing that, on the agency, on the ground. That's why I think these modest kind of declines are expected for this year,
Yeah, absolutely. Yeah, I mean, a lot of these factors, like this research, and even, like I said, Savills, Knight Frank, and all these big other real estate companies have pointed, these factors remain in place. And ultimately, we had a lot of pent-up demand, which was released after the election, which a lot of that still hasn't been satisfied because of the lockdown. So combining these factors that we just discussed with the fact that there's still a lot of pent-up demand that is ready to kind of be deployed into the market, ultimately we're probably looking at the prime central London market, and any transactions to be delayed more than anything. And that would obviously probably mean three scenarios. You might see some people withdrawing. You might see people still going ahead with the deals that have been agreed before or even during lockdown. And a lot of them might actually just be renegotiated by the different terms. But these things are very valid. It's a very positive piece of research, but in many ways it's in tune with what everybody else has been saying from all the other big companies. So it's everybody seems to,
What we can drop in here at this stage, I've got a graph that shows the online inquiry levels that have been coming through all the way throughout Brexit, and then the Boris bounce, and there was a kind of big spike at the Boris bounce and seemed like everything was on track. Then as soon as COVID lockdown came in, massive drop off. But the interesting thing is now the sales inquiries are actually above what they were, whilst we were going through this whole Brexit situation, but not at the peak of where they were post, the Boris bounce. They're somewhere in the middle. So,
Yeah.
I mean, that's either people are sat at home and just bored, or they're actually seriously looking for something to buy coming out of this. So I think it'd be useful to kind of drop that down so people can kind of see the online activity.
We've seen it within the last week and a half. I mean, we've had, I was going through the emails and I was looking at the last 5 inquiries that came in, 5-6 inquiries that came in literally just from Saturday alone. So we are seeing that, and like I said, half of those are probably speculative buyers or inquiries, where some of them will be people looking, and those are people who are probably doing a lot of research, just being prepared. The moment the lockdown is lifted, they'll be in the market looking to capitalize on any opportunities that are present. So for prime central London, it looks quite positive, because it looks like the market has just been put on hold, and there won't be any major things, and everybody seems to agree that it will remain resilient, which is positive, really. So yeah, it's good to see another very reputable organization and source to kind of come up with the same kind of analysis of where the prime property market is at the moment, and where it will be after the situation goes away and after the lockdown is lifted.
Yeah. I had another article to talk about, which was just taking everything a step back and looking at things from a global perspective, where London sits and what the market has done over the past year. We've got an index here for global property prices of cities globally around the world. London, for the first time over the past 12 months, has fallen outside of the top 10. It's been ranked in the top 10 for a long time. It's 11th place now. So it's quite strange not to see it up there. But top 3, Hong Kong, Munich, Singapore. And what I'd like to make a point. When I was reading an article about some months back about the advantages and disadvantages to living in London. And one of the disadvantages were the property prices were so expensive. So now we've fallen outside the top 10 cities. That's, arguably it's not necessarily a bad thing. But the only other thing I'd like to talk about this global research is London hasn't really been going anywhere over the past over the past year with prices, but over the past decade, it's averaged out at, let's see, 7.93%, and its long-term average is 9% a year. So the average has come down slightly on that. But the positive thing is the rental price inflation over the past 12 months, it is in the top 10, it's 9th place, and it's 4.07%. So, 4-point-something% rental price inflation every year is not necessarily a bad thing. It makes the fundamentals on properties, it underpins basically the fundamentals of the market. So long term, when we do have this, increase in rental demand, it's quite a good thing, and I think 4% is pretty healthy, well above inflation. And so that's a global study.
Yeah, I mean, I'm just looking here on the London section. There's that old saying, London is London, and it really summarizes this. Yes, there will be small fluctuations, and we've had Brexit to deal with, etc. Now we've got Corona, but the fact remains that London, of course, obviously, you said it's fallen out of this top 10, and it'll be interesting. We'll put the link of the report into the description. It'll be interesting to see what factors they've analyzed, but ultimately I think London will still remain a top 5 city in terms of attractiveness for real estate people, up there with New York, Hong Kong, Singapore, etc. And there's so many fundamental things that are not going to go away if you look at London as a whole. And if anything, as we said previously, now more than ever, it's a great time to try and get into the market in London, because we've had the prices being corrected by Brexit, etc. What's been happening since 2016. Now you've had coronavirus, and ultimately it presents many opportunities. So very interesting where London fits in a global perspective. And I think this report a lot from looking at the cities that are in the top 10, there are a lot of emerging markets, a lot of emerging countries, cities that, you know, are experiencing incredible growth, economically speaking, that are in this top 10. So, you know, but as a traditional kind of hub, I think London, like New York, will always be incredibly attractive for, you know, the riches of the world and for anybody really. So yeah,
it's an interesting point that you make. That the average property prices at the moment, Hong Kong, Singapore, Shanghai, and you've also got Shenzhen in there as well.
yeah,
But I'm not sure how many of us are going to be, you know, investing in places like China. You know, it's
yeah,
probably the reason why Hong Kong's the most expensive out of all, because pretty much most of the Chinese are parking their money in somewhere that they think is relatively safe. You know.
yeah, yeah. I mean, it's I guess that kind of concludes, right? And this week's news of the week. It is positive for the prime central London market, as a lot of the research suggests. I think, depending on how long this lockdown will last, and some commentators believe it's going to be towards the end of May, start of June, that some of the restrictions will be eased. Ultimately, we're probably looking at, in regards to even maybe the economy, but definitely for the property market, we're looking at a V or delayed V or U-shaped recovery, which leads me to believe that I think by the end of the year, Q3, Q4, we're probably looking at, you know, a lot more confidence in the market. And I think definitely central London, it could be a case that towards the end of the summer, we will see a lot of people very confident into the market, just because of the different demographic and the different nature of how prime central London reacts. And all research seems to, you know, concur with this point, which is very exciting for us in a way. And we're both really, really keen to get back into the office and kind of help people with their property goals in prime central London. But yeah, this concludes this week's London Property Podcast, episode 18. Again, I really encourage everyone, if they do have some feedback or if they want their questions to be featured in our weekly podcast and vlog, I would definitely encourage everybody to contribute. You can email us, you can comment directly on YouTube, etc. We'll be happy to engage with you. And if you do enjoy the content and you want to stay up to date to what's happening in the London property market, then by all means subscribe. Feel free to share with other people you think this could be beneficial. And we look forward to seeing you next week at another episode of our London Property Podcast show. I'm Marius Nazare.
Chris.
Oh, you cut off, Chris. Hold on.
Thanks for watching. See you next time.
Hold on. We have to do the end bit again because the internet connection was playing up. So yeah.
Am I back?
Yeah, you're back now. Oh, are you back?
Yeah.
You are back.
See you guys next week. I don't know if I'm losing connection. Problem with technology, eh?
It's still better than nothing. So yeah, see you guys next week, episode 19. Stay safe, everyone, and please subscribe and continue to follow us. Bye.